Thank you, and over to sir.
Very good evening, and thank you very much, Malhotra ji. As all of you would have noted, the GDP growth in constant prices has come at 20.1%, which is indicative of the economic recovery that is on in the economy. So I want to provide you a comprehensive overview of the economy, and these are slides that we can share with you. I'll not get into that much details, but actually focus on mostly the big picture. If you recall, exactly last year, around this time last year, on 31st of August, after the decline had happened, we had asserted that there was a V-shaped recovery that was on in the economy. We had mentioned that the decline in the first quarter was primarily because of the lockdown that India had. It had nothing to do with the fundamentals of the economy, and that is what led us to affirm that there is a V-shaped recovery that is on, and that is exactly what has transpired over the last several quarters, and especially Q3 and Q4, and now this first quarter of this year, 20.1% decline increase. If you look at this chart, clearly shows the V-shaped recovery that we had predicted, both in terms of the GDP as well as in the GVA, which has grown by 18.8%. If you look at the components of the GDP, industry has witnessed a sharp rebound, followed by services. In particular, the gross fixed capital formation has actually increased significantly, in terms of the different components of GDP. As for the second wave, as we've mentioned earlier as well, while the health impact of the second wave was significant, the economic impact has not been as large. There has been impact in the services sector, but much less on the on industry, with manufacturing growing at 49.6% in this quarter compared to last year. The vaccination is proceeding at a very good pace. The daily vaccination crossed the 1 crore mark in the month of August, and over 64 crore doses have been administered so far, with over 200 crore doses expected to be in supply till December 2021. And if you would recall, in the monthly economic report a couple of months back, we had actually projected that the 1 crore mark is possible to do, and that we should be able to get to around 70 crore people getting first dose by September, which seems to be possible given the pace that is being recorded. If you look at the cross-country variation in terms of the first and the second doses, more than half of the adult population has been covered with the first dose of the vaccine, which you're seeing on the left side. On the right side, you see the second dose, and second dose, as we go along in the coming months, the second dose coverage will increase significantly. And as we had covered in the latest monthly economic report, where we had included a box, international evidence reveals that infections fell by 65% after a first dose, and especially first dose combined with seroprevalence, as revealed by the ICMR study, does seem to suggest protection. And the seroprevalence itself, because of the infection, seems to last for about 6 to 8 months, and that is what the evidence in Lancet, British Medical Journal, etc. research shows that. If we look at the high frequency indicators, and especially the the Google mobility indicators, retail and recreation activity has clearly picked up a very sharp recovery after the decline during the second wave. Even grocery activity has picked up significantly, and both of them seem to have crossed the pre-pandemic levels, which is indicative of the recovery that is happening. Rural demand all through this last 15-16 months during the pandemic has been quite resilient, as seen in tractor sales and in fertilizer sales. The MNREGA work, which captures the demand for distress work, has sharply declined in the month of August after having declined in July as well. It had risen during the pandemic, the second wave months, in the months of April, May, and June. After that, has declined sharply, which is also indicative of the recovery that is on, both in terms of work days generated and the demand for work itself. Both of them have registered significant declines. If you look at power consumption, I think somebody
may I request someone, please mute your mics. Echo is coming back to us. Please mute your mics. Thank you.
Yeah, thank you very much. So there's been swift recovery in power consumption, with the demand growing at 18% and 17% compared to last year and the pre-pandemic 2019 level as well. If you look at the industrial production, there has been sequential improvement. 8 core sectors, the recent today estimate 9.4% for July is marginally higher than the 9.3% for the month of June. If you look at the various user industries as well, there has been swift recovery in that as well. If you look at especially steel production and consumption, the improvement is actually back to pre-pandemic levels, and this is definitely indicative of the construction sector activity, which, as you would have noticed in the GDP release itself, has recorded a growth of 68%, of course, compared to the low base last year for the same quarter. The PMI indices in the month of July have recorded a rebound. Manufacturing is in the expansion phase, and that is reflected in the 49.6% growth in manufacturing for this quarter as well. Services still is not back to the expansionary zone. While it has recovered in the month of July, it has not crossed the mark of 50 for it to be in the expansionary zone. And this is also reflected in the service sector itself, which has grown at 11.4%, in this quarter compared to last year. The GST collections have exceeded 1 lakh crore in the month of July again, after having dipped below the 1 lakh crore mark in the month of June. We expect that the GST numbers should consistently be recording above 1 lakh crore, in the coming months as well. E-way bills, the momentum has been maintained. There has been a recovery, and that momentum has been maintained in the month of August, both in terms of the number as well as the value of the e-way bills. If you look at freight traffic and daily e-toll collection, these have achieved the pre-pandemic levels, which is a good signal of the boost in the industrial activity. If you look at the petroleum consumption and auto sales, both of those, petroleum consumption on the left and auto sales on the right, there has been steady recovery and a very sharp recovery, in fact, in auto sales especially. If you look at the corporate performance, and I think this is something that is quite important in terms of the growth momentum going forward. There's the highest growth in gross sales in 5 years, and highest net profit growth in close to 30 years. Expenses have also grown, which is important from the perspective of downstream payments by the corporate sector to smaller firms, and so the expense growth is also something that is actually quite important, and the fact that it has grown at high rates is good news for the downstream effects on the small firms. Equity markets continue to rally along with a low uncertainty, as reflected in the VIX, the volatility index, which after having peaked last year around the first wave has continually declined, which is important. Typically, one has to look at not only the level but also the volatility to look at the equity markets where they are. The external sector has provided a stable cushion all through the through the pandemic, and forex reserves have continued to grow. Trade balance also is comfortable. If you look at the FDI and the FPI inflows during the first quarter, they've actually been quite robust, which is indicative of the international investors clearly seeing the growth potential that India offers now. As we had predicted, CPI inflation has softened to a 3-month low in July 2021 with the easing of the supply chain disruptions that were required during the second wave of the pandemic. It is pertinent here to also compare the inflation path during the COVID crisis vis-a-vis the previous crisis, that is the global financial crisis. You would see here that the green line is the CPI during the global financial crisis. Immediately after the crisis, inflation was in excess of 9% and then continued to increase beyond and went into double digits. In contrast, inflation has been around 6%, a little more than 6% during the last year or so during the pandemic, with WPI inflation actually being about 1.3% on average. So this is something which is important because this is despite the supply side crisis, that is the global financial crisis.
Please mute.
The green line.
Please mute your mic, please.
During the global financial.
Thank you.
Thank you. Thank you. I think it is important to understand that compared to the global financial crisis, the COVID pandemic has required imposing of restrictions and lockdowns, which have had impact on the supply side. Despite these supply side restrictions, the inflation actually being, a clear 3 to 4 percentage points lower is something that is very important, indicator of the effect of the supply side measures that have been taken over the last 1 year. CAPEX growth has grown by 26% Y-on-Y. If you look at the bond yields and the AAA corporate bond spreads compared to the GSEC, those have been stable, which is also reflecting comfortable liquidity conditions and the market's assessments of the credit conditions as well. Non-fruit credit has registered double-digit growth in 2021 compared to the pre-pandemic year of 2019. This together with the banking sector, so for the first time in several years, the public sector banks have actually recorded profits. Asset quality has clearly improved, with gross NPAs declining from 11% in March 2018 to 7.4% in March 2021. Net NPAs have declined from 5.9% to 2.3% in March 2021. And importantly, and this is for potential bad loans that may come going forward because of the pandemic itself, the provision coverage ratio has risen from 62.7% to 84% in March 2021. Especially if you look at the public sector banks, this provision coverage ratio is 88%. In other words, for every rupee of anticipated losses, almost 90 paise has been covered, has been taken care of through the provision coverage ratio. Also, capital adequacy.
Please mute your mic.
प्रोविंस है ना खेती रक्षा प्रोविंस है वहाँ पे जो
अच्छा.
Thank you. Apart from the improvement in the asset quality, as I was saying, the provision coverage ratios have improved significantly. Public sector banks at 88%. Capital adequacy, which is the second line of defense for bad loans that may come in the future. The provision coverage is the first line of defense, which has been enhanced. But even capital adequacy, the CRAR of the scheduled commercial banks is at an all-time high of 16.1%. With the public sector banks at 14%, significantly above the regulatory norms. And in particular, in the last year, public sector banks have raised capital close to 60,000 crores, I think, which is also indicative of the faith that markets are putting on the public sector banks. So I think, apart from the decline in the NPAs and the profitability now, the fact that provision coverage has been enhanced and capital adequacy is higher also tells us that lines of defense, first and second lines of defense, have been created for the possible non-performing loans that may come. And so the overall banking sector actually has emerged stronger, as a result of these measures. If you look at finally the macroeconomic fundamentals, during the COVID pandemic vis-a-vis the previous crisis, if we look at, so this is a comparison of the last year over 2008-09, 6.2% CPI inflation, about 3 percentage points lower. Fiscal deficit is higher, but that is reflecting all countries, across the board, especially advanced economies and even emerging economies, using fiscal policy to actually mitigate the crisis, and therefore fiscal deficit 9.4% is actually indicative of the fiscal policy becoming so important during the COVID pandemic. If you look at the current account balance, it was minus 2.3%, but had decelerated and became much worse later. In contrast, there was a current account surplus last year. CAPEX as a percentage of GDP has been higher. External debt as a percentage of GDP is almost at similar levels, just a 40 basis point increase. Forex reserves have more than doubled. Government bond yields, 10-year yields, have actually declined from 7.3% to 5.9%, and FDI is almost 10 times higher at 80.1 billion compared to 8.3 billion during 2008-09. And FPI, there was a net outflow of FPI of close to 10 billion during the global financial crisis. In contrast, 36 billion inflow during this crisis. So all these indicators put together suggest the macroeconomic fundamentals being much stronger as a result of the measures that have been taken over the last year and a half. In terms of the outlook, so as I had mentioned at the start of the presentation, the GDP data for the first quarter reaffirms the government's prediction of the imminent V-shaped recovery that we had made last year at this time. This prediction was based on the fundamentals of the economy being strong. Even before the pandemic, this is something that we have been emphasizing. As shown in the economic survey 2019-20, the slowdown pre-pandemic was due to financial sector problems from the bad loans that were created pre-2014, and these had actually cascading effects with the problems originating in the banking sector, creating risk aversion in the banking sector, then spilling over to the NBFC sector. So decline in the growth pre-pandemic was primarily because of the financial sector problems, did not have to do with the fundamentals of the economy. Now the banking sector has developed cushion to withstand impending bad loans, as I've just shown you using the data. Credit also seems to be picking up, and India's macroeconomic fundamentals are much stronger now than post the global financial crisis, and therefore the Fed's move at some point in the coming year to taper the liquidity conditions should not have any impact, in contrast to what happened, the taper tantrum that we experienced in 2013. And India is poised for stronger growth from the structural reforms. I've spoken about this at length, which are quite seminal. They will enable efficiency and productivity to go up. Government's CAPEX push that will enable private investment. If you see the
please mute your mic. Someone's mic is on.
The government's CAPEX push, especially in the budget this year, should enable private investment as well, because it is focused on infrastructure, and overall government's CAPEX actually has this ability to crowd in private investment, as we had shown in the economic survey this year. Financial sector has been cleaned up, as I showed you in the data, and several reforms have been launched there. And the rapid inoculation drive that is happening will help revive the contact-intensive service sectors as well. So as seen in the GDP numbers and in several of the high-frequency indicators that I've covered, the economic recovery is gathering momentum. Thank you very much. I'm happy to take questions.
I will call name one by one. We will take the question from many of the who have requested for questions. So first I am calling Lakshman Roy. Lakshman, please switch on. Unmute.
हाँ ठीक है, मेरी आवाज आ रही है सर?
Yes.
हाँ सर, मेरा सवाल ये है कि इस जीडीपी के जो डेटा आए हैं उसमें दो फैक्टर, एक तो बेस इफेक्ट, दूसरा पेंट अप डिमांड, इसका कंट्रीब्यूशन कितना है और जिस तरह से आपने आउटलुक दिया है ये कहना कितना सही है? कब तक हम लोग प्री कोविड लेवल पे ग्रोथ एक्चुअल टर्म में चले आएंगे?
देखिए, ग्रोथ तो प्री कोविड लेवल इस साल प्री कोविड लेवल से ज्यादा ही आएगा, और जिस तरह के आंकड़े आए हैं इससे हम अनुमान लगा सकते हैं कि जो हमने इकोनॉमिक सर्वे में जो प्रेडिक्शन दिया था और बजट में जो प्रेडिक्शन था वो इस बार आना चाहिए। इस साल में जिस तरह की पहले ही तिमाही में जो आंकड़े आए हैं उससे लग रहा है कि जो हमारा अनुमान था बजट के समय वो अनुमान एक्चुअली सही होना चाहिए। तो ग्रोथ के संदर्भ में तो एक्चुअली जो प्री पैंडेमिक्स उससे ज्यादा ग्रोथ इस साल आनी चाहिए और आगे बढ़ के भी आनी चाहिए। जहां तक आपका लेवल का बात है, लेवल एक्चुअली अगले साल तक आना चाहिए मेरा ये, और उसका थोड़ा एनालिसिस विश्लेषण करना बाकी है। जब आज आंकड़े अभी आए हैं 5:30 बजे आए हैं। जहां तक आपने जो बेस इफेक्ट की बात की है, जरूर बेस इफेक्ट तो है इसमें, लेकिन ये आपको ध्यान होगा कि पिछले साल जब हमने इसी समय जब हमने वी शेप रिकवरी की बात करी थी तब वी शेप रिकवरी इतना जो है इतना आसान नहीं लग रहा था उस समय। जब हमने कहा था काफी लोग एक्चुअली उसके बारे में काफी शंका भी एक्सपेक्ट कर रहे थे, जब जो कि आया है, जो रिकवरी हुआ है इसका एक्चुअली वो प्रमाण है कि जो वी शेप रिकवरी हमने कहा था पिछले साल वो आया है, वो एक्चुअली रिकवरी का प्रमाण है।
Now next question from Ruchi Bhatia.
Hi sir, Ruchi Bhatia from ET now. Just wanted to understand the first quarter numbers also go on to show that the bulk of the heavy lifting has been done by the government of India. When do you expect private CAPEX to come in? The Prime Minister has been asking India Inc. to start investing more. The Finance Minister has said that we're lacking the animal spirits at the moment. Given the fact that there is a lot of uncertainty going forward with respect to the third wave of COVID-19, when do you see private CAPEX return in full force?
So Ruchi, let me correct your question. If you look at the government final consumption expenditure in terms of the, at constant prices, there hasn't been as much of a change. In contrast, if you look at the private final consumption expenditure, that has grown at 19.3%, and the gross fixed capital formation has grown at 55.2%. Both the PFC, private final consumption expenditure, and gross fixed capital formation is basically from the private sector. So I actually am a little sort of surprised by this question, because that does not seem to match the facts that is revealed by the GDP data.
Now next, Sapna.
Hi, am I audible?
Yes.
Yeah.
Yes.
Yeah, thank you. So just a quick one, there is already talk of this taper tantrum. I think you also referred to it very briefly in your speech just now. And also the, don't know about the third wave, but that possibility is not ruled out. So both of these factors keeping in mind, I mean, how do you see the road forward, especially in terms of the taper issue? How do you think India is prepared, and your, assessment on what may unfold in US?
Sapna, this is an important question, and that is why I covered it in the presentation. First, we have to understand that international investors look at the macroeconomic fundamentals very, very importantly, and that is why I showed you the data in terms of the macroeconomic fundamentals. The way they were after the global financial crisis vis-a-vis now. And if you go back to the, there have been earlier times as well where liquidity conditions have been, quite benign, and then slowly they have been actually tightened. It's only when the macro fundamentals of a country are not very inspiring, that's when the impact actually is felt a lot more. The fact that our macroeconomic fundamentals, whether it's inflation, whether it's the current account deficit, whether it's our forex reserves, and all the others metrics that I showed you, they clearly indicate that our macroeconomic fundamentals are very, very strong. So I absolutely do not think that there should be that much of a concern. As I had mentioned, this is because of the several reform measures and the supply side measures that have been taken, which has enabled to keep inflation, from running away into double digits as it did in a post-global financial crisis, despite the fact that there was no lockdown or restrictions that were imposed then. And at the same time, the growth, projections actually, and investment-driven growth actually have been enabled significantly through the policy push, both the CAPEX and the reforms that have been announced over the year and a half. So I do foresee that whenever the tapering happens, I think India will be in a very good position to withstand that. As for the third wave, and you would recall that we had included a box in the monthly economic report in the last edition. Of course, you have to go by what the epidemiologists say, because we are consumers of this research, not producers of that research. But with that caveat, and based on the research that is being published in Lancet and the British medical journals and outlets like that, we do think that the combination of seroprevalence and the doses that are being administered, it should indicate that the COVID, the third wave may not actually be that intensive. Even if, let's say, infections go up, I think hospitalizations and deaths may not be that high, given the vaccination and the seroprevalence.
Next, may I call Shashir Sinha?
Thank you, sir.
Sir, good evening. Shishir here. Sir, you mentioned that the growth estimate which you had in economic survey as well as in the budget, that will be on the similar line. So can we expect the growth number for the year whole as a 11%, between 10.5 to 11%, or anything higher than that?
I would think it should be in that ballpark. That's what I mentioned in the presentation as well.
Thank you.
Next, Mukesh.
Sir, looking at the world commodity prices.
Can you be a little louder? Can't hear you.
No, you can.
Please.
Hello.
Mute your mics. Accept Mukesh. Mukesh now come.
Okay. So, sir, the way global commodity prices are behaving, I mean, they could pose a threat, and we can have inflation, and then it can have other consequences, like maybe RBI tightening its policy. So how much of a threat? And there's been a suggestion from MPC, some members of the MPC, to maybe cut even the tax rates on fuel, so that it somehow cools down inflation at least in different quarters. So how do you see this whole situation? Global commodity prices, inflation, then pressure on RBI to increase rates, and solutions for that, possible solutions for that.
So firstly, we've seen this moderation in inflation in the month of July, despite the commodity prices being higher. If you recall, after the May print had come and the June print in particular, I had mentioned that the sequential momentum in June seems to be, on the downside, and therefore, we expect inflation to be less than 6%, which is what it transpired for the month of July. I think that happened despite the global commodity prices. So our expectation is that the inflation in the next few months should be within that range, between 5 to 6%, but less than 6%, despite the global commodity prices, because of, as we said, on the one hand, very, very calibrated monetary policy measures and the supply side measures that have been taken by the government. As for the MPC, and as the minutes reveal, it is actually one member, who has expressed it. So I think we have to actually, keep that in mind.
Arup.
Good evening, sir. Am I audible?
Yes.
Yes.
Sir, private consumption still remains, household consumption still remains a concern. While private fixed consumption expenditure has risen in absolute terms compared to the same period last year, it is lower than Q2, Q3, Q4 of last year. Now, everything that you have done since last year, be it Atmanirbhar Bharat and all these announcements, you said it was aimed at increasing household incomes and household consumption, but that has not happened. So, where is the way out of this to improve household consumption and private consumption expenditure?
So, as you mentioned, we did see in Q2, Q3, and Q4 the private consumption increasing significantly, especially in Q3 and Q4, and that was as the fear of the pandemic had subsided. And if you recall, this number 20.1% that we've seen, and the consumption, private consumption growing by 19.3%, is despite the second wave. We all remember the second wave and the restrictions that were placed by several states. We saw the decline in the grocery activity, retail activity, etc., in the month of May and June. So this increase has happened despite the the restrictions that were imposed on by states. Of course, in the second wave, one of the key things, the key differences was that the restrictions were placed at the state level. As a result, the restrictions were heterogeneous in their intensity and were also asynchronous in time, and that has really helped in ensuring that the impact of the second wave has not been as large. So the way I look at it is that as we go along and as the inoculation drive is proceeding at a fast pace, what happened in in Q3 and Q4 should come back going forward as well, because Q3, Q4 the impact was as the fear of the the pandemic had actually receded. That's what led to the consumption, and I think same thing I anticipate, because you have to keep in mind that this print that we have seen is despite a very, very intense second wave.
Last question from Shubham.
Hi, sir. Shubham Batra here from Informis Media. Sorry, my camera is off because my signal's a little patchy. So my question's related to the July spending numbers that have come today. The centre's total expenditure has fallen 23% year on year, and CAPEX, in fact, has declined 28%. So if you could just elaborate on these numbers. These are the numbers for the month of July.
I lost you in between a little bit, Shubham. Can you just repeat? There was a part that I lost you.
Am I audible, sir?
Yeah, you're audible, but there was a break in between.
Okay, so the question is related to the spending in July. The centre's total expenditure has fallen 23% year on year in July, and CAPEX has seen a decline of 28%. So I just wanted to ask you the reasons for that.
Primarily because of the second wave, and there were restrictions that were put. States like some other states where the CAPEX is large, states like Maharashtra, Gujarat, etc., had a very intense second wave where restrictions had to be put. So I think we have to keep in mind that these prints that have come, for whether it's for consumption or for investment, all of these are despite the very, very intense second wave, which, the restrictions that were imposed actually did have some impact. But, we absolutely plan to, to fulfill the targets that we've laid out for capital expenditure in the budget this year. And so we should see acceleration, in the CAPEX in the coming quarters, when as we are seeing, hopefully this recovery will continue, and the third wave will not be as intense given the inoculation and the seroprevalence numbers that we have. So we should be able to accelerate on and move on the planned capital expenditure that has been budgeted in the budget this year.
Last question has come from Surya Murthy. Surya Murthy.
Good evening, sir. Am I audible?
Yes.
Yes.
Yeah. Which of the sectors are seeing any green shoots in the economy? Are you seeing any green shoots in the economy? If so, which sectors? And the numbers which have come is basically due to the base effect. The numbers, the GDP numbers which have come is due to the base effect. If we compare with the 2019 fiscal year FY20, if we compare with that, how do you see the data?
See, as I've mentioned, of course it is a base effect, but at the same time, what you have to keep in mind is that this has happened during a much more intense second wave. If the second wave from a health perspective was far more intense than the first wave during the same period. So the decline, in the last year, same quarter had happened during the first wave. And now what we've seen is basically, is a improvement, significant improvement of 20.1% in the GDP, despite the second wave. As for the green shoots, as I mentioned actually in the presentation as well, there is, across the board improvement seen in a lot of high frequency indicators, construction sector activity, which had grown significantly in Q4 as well, close to 15% compared to a high base, in the previous year. Now, compared to a lower base, construction sector activity has grown at 68.3%. Manufacturing has grown at 49.6%. I think overall industrial activity actually seems to be clearly picking up. It is also seen in the PMI indices being in the expansionary zone for manufacturing. I think the areas where we are still sort of, not seeing as much green shoots, it's primarily in the services of that, the contact intensive services, where there is basically the revival has been impacted because of the second wave. I think if you look at the numbers overall, it's the contact intensive sectors that have been impacted the most because of the second wave. Other sectors have actually clearly, shown a lot of momentum despite the second wave.
Thank you, friends. Thank you. Thank you, sir.
Thank you very much.